Hey everybody, hope everyone's doing well. This is the Emini review for Monday, June 17th, 2024. And overall, pretty interesting day. And there's a couple things I want to say about the day before I get into it. For one thing, it's easy to look at this day. And this is the type of day that beginners will look at and say, oh, trading is so easy. You just buy above bar 5 and you hold for a swing and you make a windfall of profits. Or you buy anywhere and just hold. And what's frustrating about days like this is they don't happen very frequently. This is actually a low probability event. And what can be frustrating is you have these buy climaxes like up to 36 or even here, 46 and all the way up. And you're thinking this has to be the one that reverses. It's an exhaustion gap. It's a wedge top. And it just keeps trending relentlessly and it can be frustrating. So for one thing, don't beat yourself up over a day like this. And the most important thing to learn from a day like this is to not look too short. And I will say one thing with that as well. Bull trend days in general, but for this case, bull trend days, you often get a sell-off late in the day, which is profit taken by the bulls. And so if you're going to sell, maybe you look to sell at the end of the day or in a trading range, high in the range, possible profit-taking sell-off into the close. But that's just bonus. That's an extra. You want to be looking to buy in the bull trend, and at the very least, don't be looking to sell. And with that said, it is Monday, so we'll look at the weekly chart first. And this is the weekly chart bar so far. It's Monday, so it's been one day in the bar. The market's in a tight bull channel. Maybe this is the trend line. And you draw the parallel. And it looks like the market is behaving within these lines. So we had a really tight rally, trend line break, and then the bears were hoping for this retest to be weaker. We get a double top, maybe a major trend reversal, but instead we just hesitated, and now we're continuing. And so this could continue in this channel until there's more selling pressure. But we are early in the week. We have 4 more days to go. If the bears can disappoint the bulls on this week and close below the midpoint, some traders will view it as a low 2, low 1 below here, and then low 2 below this bar. Others will view this as a low 1, but because it's 2 legs up, maybe more and more bulls will exit. That's the hope for the bears, but for now, this is too much buying pressure to be looking to sell. But as far as the daily chart goes, the market, by the way, if you've seen my other reviews, you might notice the daily chart looks different on this video, and that's because I'm using the extended hours, the overnight session on this chart now. It's more clear to see. There's less gaps. And so we're looking at the daily chart here. And here it is again, the tight bull channel, trend line break. Bears hoping for maybe a double top here, major trend reversal. But this was so strong and the selling pressure was so weak that it wasn't enough. And you can see we pulled back to the moving average and it became a minor reversal, a pullback. We fell below the swing point and then rallied to a new high. Is this a major high or low? I don't think so. You can argue that this high or low led to a new high, but it wasn't a very strong close at the new high. This one didn't get to the new high, and then it was small overlapping bars. Maybe you're more careful and use this one. If you do use this one, you know the odds are the first reversal attempt is going to fail, and there's buyers below, and that's why we found buyers below. So at this point, the market might be in a trading range or a bull trend. The bears looking for a second reversal. So bull trend line break, looking for a second reversal, and they're not getting it. And we're getting the bull breakout. Now, one problem I see for the bulls is that maybe we're getting a breakout attempt of a bull channel. You can call it a wedge. The problem is that we're getting a bull breakout of a wedge top. That's a lower probability event. It's not that it can't happen, and when it does happen, it happens quickly and in a big way. But the real problem for the bears here is the lack of selling pressure. This is a tight bull channel. This was not enough selling pressure to convince traders that this would be a double top major trend reversal. And then this is a strong enough rally. Itself is probably going to get at least a second leg. So maybe it's leg one, pull back, leg two, pull back, and then a third leg. So the bears, the moral of the story is that the bears need to do more. And let's get into the 5-minute chart. So let me just draw the high of yesterday, and then we'll get into it. So today there was a gap down. There was a small gap down. If you look at the prior day, Friday, I might call it yesterday. Whenever I say yesterday, I'm referring to the prior trading day. So if it's Monday, I'm talking about last Friday. So if you look at the prior day, we have a bull channel. And you can draw it different ways, but basically a bull channel. Then we have a gap down, trying to break below the trend line. But it's a weak breakout attempt. We broke below the trend line and reversed up immediately. So bar one, bull reversal bar, closing near its high, but it's completely below the moving average. Always keep in mind that the first bar of the day, bar one, remains the high or the low of the day 20% of the time. So the odds are that we'll usually trade above and below bar one. And that reduces the probability for buying above bar one, even though it's a bull reversal bar on the bull trend line. The bears hoping we're in a trading range, which you can argue the market is in a trading range. And if you just look at it from here and you look at the, let me turn off the snap mode. If you look at what I'm highlighting with this green rectangle, you would say the market's sideways, it's in the trading range. And that's true. But we have had a series of higher lows, so the bulls will argue bull trend, and there's a greater risk of an upside breakout. It's also relatively broad. One problem with broad bull channels, especially, is the chances of the breakout of the channel line, usually about 25%. Obviously, context makes a difference, and the steepness, the strength. So if you have a tight bull channel, there's a greater risk you get a channel line breakout, and that's what a parabolic wedge is. And then the reversal ends up being minor. It's a breakout on a higher time frame, and the market goes higher. In this case, it's a fairly broad channel. You're expecting the downside breakout, but at the same time, you have to watch the price action. Do you really want to sell after seeing bar one try to break below and close above the trend line? Not yet, at least not yet. So bar one, bull reversal bar, below the moving average, probably sellers above and buyers below. And then bar two, we tried to get above the moving average and failed immediately. And bar two, closed on its low. It's a bear bar, but it's a small bar at the trend line after a failed breakout. There are probably more buyers below. You're also, let me back up with bar one. If you're looking to buy above bar one, think about where you're looking to buy. Let me see if this is what I'm looking for. Yeah, that does the trick. If you can see these lighter blue lines, the market's in a trading range. Here's the upper third, here's the middle third, and the lower third. And so you can see we fell into the lower third and found buyers. At this point, bar one, if you're buying on a stop above bar one, you're taking a chance that bar one remains the low of the day, which is 20% chance of the 20% of the time. And you're also forced to buy in the middle or upper third of the trading range, which is never ideal. And that's why nobody bought. But the problem with bar two, it's a small bar. So small bar, small risk, good risk reward profile, low probability. If you sell on a stop below bar two, stop above two, you're probably going to lose the trade. You also just had a failed bear breakout of the channel, the bull channel, so the trend line is holding. The odds are it will hold again. It's held for all of these breakout attempts. And then outside bar, bar three. The market's sideways. The first three bars are overlapping each other. Bar three, it's an outside bar, so an expanding triangle. Probably sellers above and buyers below. and then an outside bar on bar 4. So an outside pattern, OO. Outside is just a breakout mode pattern. The market's searching for direction. It's probing up and down, up and down. So what's the problem with bar 4? Can you sell bar 4? There's a couple of problems I have with bar 4. First of all, we're trading below bar 1, where there are probably buyers. We had a rally after a trendline break, but a weak trendline break, and the market's in a trading range. If we go lower, probably going to find buyers below bars scaling in. Bar 4 is also an outside bar, and outside bars themselves are trading range bars. It's an expanding triangle on a lower time frame. It'd be clearer on a 1-minute chart. And if you think about it, you don't want to sell at the bottom of a big bear trend bar that's a trading range. You're selling low in the range, and that's where traders are buying. So for a couple of reasons, I suspect that bar 5 will disappoint the bears, selling the close or selling below bar 4. And the odds are there are buyers below. And then bar 5 is a disappointing bar. It's an inside bar. It's a double bottom for the bulls, bar 1, bar 5. And then bar 5 is disappointing enough for the bears that if they did sell, if a bear sold the close of bar 4, trying to front run the breakout, they got trapped on bar 5 and they may just exit the trade. And that will induce bulls to buy the close and buy above bar 5. Bar 5 is also a possible double bottom low of the day, possibly low in the trading range, and we could test all the way up to here, the high of yesterday. And then if you think about it, most days trade above or below the prior day's high or low. And so here's the high of yesterday, and here's the low of yesterday, and we're obviously closer to the high, so we're probably going to go above the high. And then 6, another bull bar, so it looks like bears giving up, buying back shorts, bulls buying to get long, maybe taking a chance. This is a double bottom, early low of the day, in a swing trade. At a minimum, bulls are looking for a scalp, maybe get above bar 4, maybe get above the high of yesterday. One more thing I should have mentioned on bar 4, I'm just seeing it now, I should have mentioned it. Remember I said bar 2, small bear bar, so small bar, small risk, good risk reward. And so if you take that trade, you sell on a stop below bar 3, you're actually expected to see the stop get run. So if you are selling bar 2, it's wise to use a wider stop. Your stop got run on 3, and then even a wide stop might have got run on 4. 6 is also a low 1 short at the bottom of a trading range. And that's never a good trade. It's a bull bar, consecutive bull bars, probably buyers below, maybe buy the close, bar 6, expecting higher prices, but it's sideways and we're below the moving average. Probably sellers somewhere up here. And then another inside bar on bar 7. What the bulls have going for them, it's a micro channel. Since bar 4, every low is at or above the prior low. The closes are closing above prior closes. But the problem, there's no micro gap. The high of bar 6, or the high of bar 5, if a bear sold above 5, scaled in higher, bar 7 overlapped their original entry price. And they would have been able to afford a loss, and if they scaled in, they'd make money. So not ideal for a bull breakout. But the bears had to scale in higher and try to avoid a loss. So that's also not ideal for the bears. The bears have tried twice. We went down on 1, pulled back, down on 4. Maybe the bulls are trying here. We might have a possible rally, maybe a bull spike, but it's not very strong yet. And then bar 8, we had a decent bull bar. It's a bull bar closing on its high above all the bars to the left. But remember what I said earlier about context and where the market is. Here's the start of the upper third. So the market's now in the upper third of the trading range. You can buy the close of bar 8, betting we get a bull breakout. This is strong enough up. It should get a second leg to the upside. But you're buying in a place that's not ideal. You're buying in a place where bulls are taking profits and bears are looking to short. Now, bears are not necessarily looking to short after 4 consecutive bull bars. But the problem with bar 8 for the bulls is you're getting the strongest bull bar in all the bars, 4 consecutive bars, on the last bar. And that's a warning that it may be climactic and a sign of exhaustion, so we may pull back here. It's an incentive for bears to short. There's probably sellers above bar 4. There's sellers above in the trading range, scaling in higher. But again, the momentum up, the fact that it's a micro channel, probably going to get a second leg up. Bar 9 went a little higher, but you can see disappointment for the bulls. Now is bar 9 going to reverse this? Probably not. It's probably a minor reversal. So it's still a micro channel since bar 4. We've had maybe 6 bars up. But 2 of the bars are bear bars, and the bull bars are overlapping a fair amount in here. At this point, the market is still in a trading range. And if you remember the rectangle I drew earlier, you wouldn't argue with me if I said the market's in a trading range. Now, what that means, though, is the market's in breakout mode. You can see where the market's constrained between these 2 prices up here and down here, and we're probing up and down. So we're going back up. And if you were to judge the buying pressure and selling pressure within the range, you can take a quick glance and see there's a lot more bull bars closing near their highs, and the bear bars are getting big tails below. And the majority of the bars are actually staying above the moving average. So these are all hints that there's slightly stronger buying pressure, plus the higher lows I mentioned earlier. Now we're getting a spike, and then bar 9, like I said, not enough to disappoint the bulls. Probably buyers below, scaling in lower, looking for a second leg. 10, we did not trade below 9, and instead we're going higher. We're testing the high the prior day. The odds are we're going to break out and see what's there. We're so close to it on the high of bar 10. Some institutions will buy the close of 10, betting we came so close, and we're probably going to get there. It's a magnet, so you can buy there for maybe a few ticks or a few points for a scalp. But that is the behavior of high-frequency trading firms, or at least that's the way I think of it. Strong enough bull channel. I call it a bull channel. It's technically a spike even on this time frame. And as always, I apologize for any background noise. Technically, this is a spike. No low went below the prior low, and so there's no pullbacks. But it wouldn't take that much drilling down to see this is a channel because of all this overlap, the tails on the bars. So we had a channel, a breakout, and then another channel. Now we're high in the range. So more and more traders will look to sell, betting we're high in the trading range, but tight enough, I keep saying it, but tight enough breakout, we'll probably get a second leg. The problem with breakouts in the trading range is you get deep pullbacks. And then 11, we fell below bar 10, but the odds were there are buyers below bar 9, bar 10. It starts to damage the bull case if you fall below the third to last bar in the micro channel. So we fell below the prior 2, but not the third. You can see we fell below bar 10 on bar 11 and then found buyers into the close. So not a very strong bear bar, but it's strong enough. There's probably sellers above. It's a high 1, but a weak signal bar and bad context. And then 12 going lower. Now we fell below bar 8, so it's damaging the bull case a little more. But at this point, it might just be a 50% pullback of the rally. And it's closer to 70 maybe. We did fall below 50. But it's a trading range and possibly a bull channel. So you will find support at the 50% pullback of this rally. Consecutive bear bars probably get a second leg down, but it's minor. 12, high 1, probably sellers above. You have bulls who bought the close of bar 10. They're trapped. They'll use any bounce to exit. 13, a bull bar, triggering the high 1. And coming close to the close of bar 10 where bulls were trapped, if a bull bought, scaled in lower, they were at least able to exit at their average price and almost at their original entry price. 13 is disappointing for the bears. They're trying to get consecutive bars, but there's tails below. This is 2 legs down on a lower time frame, bar 11 and 12. And then 13, a bull bar, probably buyers below 13. It's a weak low one short, and it's a bull close, and then that means less traders will sell below the bar. There's more support below. For the bulls, 13 isn't the ideal setup. It's a high one, but your signal bar was actually bar 12. 13 is the entry bar, and now you have a bar with a tail on top, high in a trading range. And you still have bulls who bought the close of 10, still trapped. And then 14, there's a tick gap into the open of bar 14, and you can see what happened when we tested the close of bar 10. Traders sold out of their longs. But you have to think about the bear perspective. There's always an opposite, and you always have to think about both sides. And that's why I do the reviews in the fashion that I do them. I'm always trying to figure out what the bulls and what the bears are thinking. And they're trying to figure out their trader's equation, their probabilities, the context on every tick. And so I just mentioned bad high one for the bulls, probably sellers above. And there were. But what does that mean for the bears? The bears are hoping this is a double top, maybe a lower high double top, bar 14 and bar 10. Maybe they even argue head and shoulders, left shoulder, head, right shoulder, and then we sell off to the bottom of the range. And it's possible. But the problem is you still have a strong enough rally for a second leg. And I don't think this was a sufficient second leg. Whenever there's a breakout strong enough for a second leg, the second legs are usually symmetrical in size, or at least closer than this one. So the bulls have done the bare minimum. Breakout, pull back, second leg, testing the high close. That's what I consider the minimum. But when you think about the bear case, the bulls have now controlled maybe 5 or 6 bars above the moving average. We still have this strong enough breakout for a second leg. And if you're selling below 14, you're selling below, it's technically a sell reversal bar, but it has a bull body, so consecutive bull bodies. And the selling pressure is not very strong. You've had really 2 bear bars in the past, 8 bars or so. And the bear bars have tails below. Neither one of them closed below the moving average. The moving average is either flat or slightly rising. So this is bad context and bad price action to be selling. So probably more buyers below 14. And then 15, you can see the market went outside up. So there were buyers below 14, but sellers above 14 as well, because you're still high in a trading range. And on a smaller time frame, this is 2 legs up. Well, let me back up. This is 2 legs up. You can see it here. 1, pull back 2. What's on a smaller time frame is the second leg was a wedge. Up on 13, pull back. Up on 14, pull back. Up on 15. Outside bar, the market's in a trading range within a trading range. It's breakout mode. And remember what I just said about the selling pressure. If it's breakout mode and there's weak selling pressure, there might be an increased risk of an upside breakout. We're still high in a trading range, and traders will sell above bar 15, betting the breakout will fail. We're high in the trading range, and that's a fairly reasonable thing to do because 80% of breakouts of trading ranges fail. 16, bear reversal bar, but a doji and an inside bar. So it's a similar problem with selling 14. The context isn't great. The signal bar is an inside bar, which reduces the probability. Probably buyers below and sellers above. And then 17, we traded below the inside bar and immediately pulled back. There were buyers below. But 17 is a doji. It's a high one at the top of a trading range with a doji signal bar. The odds are there are sellers above. This is a really tight trading range, and tight trading ranges are breakout. It's a form of breakout mode. It's also a triangle, which is breakout mode. And as always, the point I'm getting at is the market is getting squeezed. And you can see it was a bull channel over here, but now we're getting higher lows and lower highs. The market's in a triangle, tight trading range, barbed wire, whatever you want to call it. It's breakout mode. You know a breakout is probably coming soon. The breakout can fail. It can go the wrong way 50% of the time. So the first breakout may be a failure and then it can reverse. But I would be expecting a breakout fairly soon. I'll actually redraw that for context. 18, we have a bull trend bar. So possible breakout attempt for the bulls. Closed above the high yesterday, and that's good, but there is some selling into the close, and the bar just barely closed above yesterday's high. The bulls at this point still need follow-through. Some bears will sell the close of 18, betting that they won't get follow-through, betting it's one pullback, 2 legs up, high in a trading range. But consecutive bull bars, one closing on its high, and the bulls just looking for follow-through here. And then look at bar 19. So if you're a bear and you sold above the high of yesterday, you sold the close of 18, above 18, if you sold anywhere, you're very disappointed with your entry bar 19. Now when you see 19, for the first time today, well, at least this is the first time I'm mentioning it, and I'll go back on this later, but 18 and 19 consecutive bull bars closing near their highs, above the moving average, 19 closing far above all the bars to the left. This is always in long, and that's a strong enough breakout for a second leg. Now, is it possible that traders sell the close of 19, betting we still need one more bar for the bulls, and 50% of breakouts of triangles fail? All that is true, so some traders will take that trade. But that's the type of trade that's aggressive, and they need immediate follow-through. So if you sell the close of 19 and 20 doesn't just plunge down, you might give the trade 20 seconds. And if it starts to pull back or continue higher, if there's momentum to the upside, you just give up on the trade. Your premise was invalid. 19, probably buy the close, stop below 18, and look for a measured move up. You can look for a measured move of bar 18 and 19, the low to the high, the bodies. You can look for a measured move of the triangle, the trading range, maybe up here. And then more follow through for the bulls on 20 and a tick gap. So the close, the open of bar 20 is one tick above the close of 19. Now we have 3 consecutive bull bars with very little overlap, big bodies, small tails, uniform sized bars. This is a really good looking breakout. It's the type of breakout, I said bar 19, you buy the close. 20, you can buy the close as well. Probably going higher. And even if it does pull back, the odds are at least 60%, and realistically, probably more like 80%, that this will get some sort of second leg. Now, is this a second leg? 1, pullback 2. For me, I would actually call this leg 1. And the reason I would reset the leg count, there's 2 reasons. And the first reason is that it was breakout mode. So the market's in breakout mode. What happened in here is part of the trading range, and now we're getting a breakout, and the breakout is strong. So those 2 reasons combined are enough for me to say this is a leg count reset. We're probably getting a second leg. The market cycle is resetting. So this is a breakout. Then we're expecting a pullback at some point, and then the pullback will convert into a channel, and then the channel should convert into a trading range. That's the market cycle. I said you're expecting a pullback at some point, and I'll be more specific with that. But the reason you're expecting a pullback at some point is because at some point, the bulls who are buying the close, the risk is all the way down here. The reward's up here. Now at this point, the momentum's good, the breakout's strong, it's still a reasonable trade. And we probably will get here, even if we pull back first. But what happens is eventually the risk gets too big, and the bulls get uncomfortable with the risk, or at the funds, their risk managers are walking around the room, making sure everybody has the appropriate risk. And the easiest way to reduce your risk is to reduce your position size. And how do you reduce your position size? You take profits. You could also reduce your risk by moving your stop from below bar 18 to above anywhere higher. But the problem is there's no logical place for a stop. In a spike like this, you're expecting buyers below bars with limit orders. So if you pull your stop higher, that's what Al would consider a skunk stop. And you'd actually be exiting where the strong bulls are buying. 21, it's an implied pullback, overlapped bar 20, basically 100%. And 21 is also a high 1 signal bar. It's implied. There was no technical pullback on this chart. But the odds are it's a strong breakout, leg 1, and bar 21, probably buyers above. Because when you get a high 1 and a strong breakout, you're expecting the trade to work quickly. I said over here the opposite. I think I said it with bar 6. Bar 6 was a low 1, low in a trading range. So that's a bad trade to look for continuation down. But here, a high 1 and a strong bull spike, probably buyers above. 22, more buying. It's still buy the close, buy for any reason. But we're getting close to that point, at least for me. And I don't know how to explain this well yet. It's more of a feeling. But I'm talking about how here's your risk. And if you're buying here, now your target, your 1-to-1 is all the way up here. And the odds are we'll pull back before we get there. And if we'll pull back before we get there, why buy the close when you can buy a pullback? But still, buy the close, buy for any reason. Wide stop, scale in lower. And then let's look at this measured move. The measured move of the triangle or the trading range. And that's right here. So let me just draw that. Now I'm going to change the color. There's a lot of red. Measured move of triangle. Now, what about the bears right now? The bears are stepping aside. They know the market's going higher. And they're not looking to sell during a strong rally. They're expecting higher prices. And then even after the rally, they're expecting a pullback and then a second leg up. Everybody knows this. So the bears, they're not selling above bar 21. They're not selling bar 22. They're waiting for higher prices and magnets to get tested. They know the market's going higher. So why would you sell here if you think we're going here? 23, more follow through for the bulls. Really relentless buying. And it's really good for the bulls because the market, let me explain why this breakout is good for the bulls. The breakout has a lot of characteristics going for it. The first one that stands out to me is that the bars are uniform in size. No bars are way bigger than another bar or way smaller than another bar. They're all fairly similar in size. I actually have give me just one moment. I gotta pause. I actually have a study, and it's very simple. If you have TradeStation with the easy language, the show me, and I have a bar range where when you hover over a bar and click, you can see at the bottom of this list, plot 1 and plot 2. Plot 1 is the bar's range, and plot 2 is the body's range. And so if we look at plot 1, that's the bar range. We have 4, 4.25, 3, 3, 3.5, 3.75. So all the bars are between 3 and 4 points. And it's really an orderly breakout. And so that's the first thing. That's the first characteristic of strength. Now another thing, it's a micro channel. There's no pullbacks. So from bar 17 to bar 23, every low is above the prior low. Every close is above the prior close. Now not every bar is above the prior bar's high. If you look here, the high is 55.10 and a half, and the close 55.10 and a half. So it's not terrible. It's closing at the high. It would be stronger if it's above, but that's the only bar not closing above the high of the prior bar. All the other ones, we have close above the prior high, close above, and here. We also have a tick gap. I mentioned the open of bar 20 opened one tick above the close of bar 19. That's a sign of strength and urgency. As soon as this bar closed, everybody clicked the button, buy the market, buy immediately. And if you set a limit order to buy the close of the bar, you may not have been filled. Generally, the market has to go one tick lower than your limit order to fill you. And similarly, if you have a profit target and the market touches your profit target but does not go one tick beyond it, sometimes you won't get filled. And so that's why here you have bulls desperately trying to get long, trying to buy the close of bar 19, and then 20 may not have filled them, and then they're forced to chase the market up and buy the market. Another characteristic that this breakout has going for it, there's not a lot of overlap. Bar 21 overlapped bar 20 a lot, but that's the only one. All the other ones have no overlap. And so that's a sign that there's trapped traders. If you sold anywhere, where did you get a chance to exit at break even? When did it come back and retest your entry price? Happens all the time in here in trading ranges, but this is a bull spike. So if you sold above 17 betting high in a trading range, or 18 betting failed breakout, even aggressively sold 19 betting 20 would just plunge, you're trapped no matter where you sold. And the market is just going higher and higher. And now I mentioned, well, actually, let me just continue with the characteristics of strength. You can see no bar has a huge tail on top. So there's not a bunch of selling into the close of any bar. All the bars close near their high, and that's a sign of strength. No bars have giant tails below. 21 is an exception, but it's one bar out of all these bars. The breakout, there's also two other major important factors, and one is that the breakout covered a big distance. Look at what happened if you sold here and the market a few bars later is all the way up here. That's a big distance. How big is it? Let's say it's from the low of 18. The market has gone about 14 points. It's doubled the day's range, or the opening range. And with that, how many bars are in the breakout? 1, 2, 3, 4, 5, 6, 7 bars. So that's time control. The bulls have controlled the market for 7 bars. Now, when you get to 7 bars, most micro channels are between 3 and 7 bars. So once you get to that 7 bar mark, the probability of a pullback is actually higher than continuation. And so for that reason, along with what I was saying earlier, say you're buying the close. Actually, this is another discussion. How do I want to explain this? If you're long, it's as if you're buying at every moment, because this is what Al's talking about. There's no such thing as other people's money, and when you're in an open profit, your risk is the current market price to your current stop. It doesn't matter if you bought down here or bought here. If your stop is down here, that's your risk. And so if you bought down here, you're at an open profit. That's the problem with buying here. You have bulls who bought down here. They caught this breakout. The market moved 14 points. And so if you're buying here, the close of bar 23, stop below 18, that's the theoretical correct stop. Your 1-to-1's all the way up here. You know the market's probably going to pull back. Plus you add that with, we're at 7 bars in the micro channel. And so the probability of a pullback is getting higher than continuation. So those two facts combined will be reasons enough for bulls to start taking profits. And so when that's the case, you can expect a pause and a pullback here. And so one more thing, I want to make it more clear with other people's money. Whenever you're in any trade, it's like I said, it doesn't matter if you bought here or bought here. It's as if you're buying on every tick. So that's why traders are paying attention to the trader's equation on every tick and the context. Because it's great to be long in here, but at some point the probabilities shift. And then the probability becomes higher that we get a pullback. And then the bulls, their risk gets too big, whether it's uncomfortable or whether it's maybe some kind of rule for the firm. Bulls have to take profits at some point. And so the profit taken by the bulls means the bulls are selling. They'll look to buy lower. The market has to go lower to find buyers. And then 24, finally a bear bar, but it's an inside bar. So lowers the probability. And you know what I'm going to say. Obviously, strong enough breakout, probably will get a second leg. Buyers below 24, scaling in lower. 24 is a high one, but we already had a high one at 21. Now we're getting late in the breakout phase, and it's a bear bar. So if we do go above 24, that combined with the fact that it's an inside bar tells us there's probably sellers above. 25, a bear breakout attempt. but it could not close below bar 23. Looks like it closed at the low, 11.5 and 10.75. It actually did close below the low. Is that true? 11.5 and the close, 11.5. I looked at the wrong number. So it closed at the low of 23. And so that's a sign of weakness. The bears, why couldn't they close below more bars? Well, the reality is, I'm talking about the bears, but it's like I said earlier, this selling is from profit taking by the bulls. Bears are not really selling here. Maybe you start having bears selling because they know once you get 7 bars in a micro channel, the odds of a pullback become greater than continuation. Maybe they sell for a scalp, but the downside is really limited, and they know there's buyers below bars. There's buy limit orders below bar 23, below 22, even here, anywhere, 50% pullback. And now we have consecutive bear bars, but big tail below 24, so maybe leg 1, pullback, leg 2. And then we fell lower on 26, but buyers below there as well. So now you think about it, 3 consecutive bear bars and a 4-bar bear micro channel since bar 23. Strong enough that it'll probably get a second leg, but you have to realize, you have to think about it from the point of always in and minor versus major reversals. And this is a minor reversal. And if it's a minor reversal, what you're expecting is a limited downside, and worst case scenario for the bulls is a trading range, but this could easily be a bull flag and continuation in the bull trend. And so I said it's strong enough for a second leg, and I do believe that, but I think the second leg, first of all, why is it strong enough for a second leg? You had bulls buying the close all the way up. They got trapped here. Bulls bought the close of 23, trapped by 3 consecutive bear bars. They'll use any rally they can to exit and look to buy lower. The bears, they see maybe strong enough momentum for sellers above, and then you combine that with 26 being a weak high 1, because it's 3 consecutive bear bars and the signal bar is weak. And so that alone, there's sellers above 26 for a scalp. 27, a bull reversal bar closing on its high. But every breakout bar is a test of support or resistance. Let me see if I can change this really quick. I want to look at the 50%, and I'll turn these ones off. Maybe a bull bought the close of 23 and bought more above 26. And where's the midpoint of 27 racing to? The midpoint of their entry, their average price. And so, remember I said probably strong enough for a second leg down. So maybe it's leg 1, pullback, leg 2. One more thing. I was looking at the bulls there, but for the bear leg, here's the bear leg, here's 50%. So some bears are selling there, selling higher. But if you did sell above 26, and 27 is your entry bar, you're fairly disappointed. And you have the risk that this could continue to the upside. Bear bar 28, so we tested higher, not quite to the close of 23, but bulls who bought there and scaled in lower were able to avoid a loss. And now 28 is a low 1, or it's a low 2 sell setup. It's a lower high, double top. But the selling pressure is weak, and it's still a minor reversal, not a major reversal. There's no major trendline break here. The market's simply going sideways. The bulls, the risk got too big. They're looking to buy pullbacks and buy lower. Leg 1, pullback, maybe leg 2, and a high 2. Maybe they look to buy the moving average. But at this point, the big picture overall, we just had a strong leg 1. We're getting a minor reversal. We'll probably get a second leg up. And so the problem with selling bar 28, it's a fairly weak bar. It's a trading range bar overlapping bar 27 in the middle of a trading range, and the trading range is in a bull spike, a bull trend. And so you'd be selling low in a bull flag. That's a low probability trade. Inside bar 29, so what that does is even further lower the probability for selling below because it's an inside bar. The bears are just hoping this is a tight trading range, maybe final flag, triangle, reversal. Maybe the bulls get one more breakout and then a reversal, but that's the lower probability event. And what's more likely is we have strong bull trend above the moving average, leg one, pull back, leg two, look for a high two to buy, and trend continuation. So probably more buyers below 29. 30, we fell below 29 and got a bull bar. It's a bull reversal bar. It's a trading range bar. And it's a high two signal bar. 2 legs down, 1, pull back, 2. And now 30, reversing, closing above its midpoint. And if you think about the always in argument, not that we ever went always in short here, we're still always in long. But if a bull did exit for any reason, they will enter again above bar 30. It's a second reversal up, and it's a bull bar closing above its midpoint. It's a high two above the moving average. Now, if you do buy there, your stop goes below the spike. If you buy here and put a stop below 30, that's another example of a skunk stop. 31, bull bar, and there's actually a tick gap from the close of 30 to the open of 31. There was urgency. And the close of bar 30 is 55.11 and a half. And then the open, we had a tick gap 11.75. And the low of the bar tested the close. But again, traders trying to buy the close of 30 with limit orders may not have been filled. So there's a sense of urgency. What about the bear argument? The bear is hoping it's still some sort of reversal pattern, but the reality is it's minor. And now you'd be selling against 2 consecutive bull bars. There's probably buyers below, scaling in lower. And so the bears, I don't know if I already said this, but the always in perspective, always in long. Oh yeah, it's like I said, bulls, they're going to buy above 30. And bears, if they were being aggressive, looking for a low probability reversal, they will also exit above 30. So traders are buying above bar 30. It's a second reversal, trend continuation. The bears tried twice, tried here, failed, tried again, failed, and we're reversing back up to the upside. It's also a perfect double bottom, bar 26 and bar 30. So what we have here is a double bottom, high two, bull flag. Doji on 32. We're getting high in the range. This bear bar, there's resistance above it, but it's minor. It's a bull flag, and the odds are, if this is a bull trend, resistance is not holding, and the bulls are breaking out above resistance. Do you want to sell below bar 32? When in doubt, think about the opposite side. Is this a major trend reversal setup? No. You don't have a major trend line break. You don't have big bear bars, consecutive bear bars. Only one of the bear bars closed near its low, and it was an inside bar. This is not good enough selling pressure. And this breakout is really strong. I told you all the characteristics that were strong about it, and I probably even missed some. But the point is, it's really strong, and there's a really high probability, maybe 80%, we get a second leg that is similar in size, or that we get a measured move of the breakout, or both. And I should draw the measured move. And so that is this price. 33, you can see we didn't trigger the sell below. Nobody was interested in selling below 32. Instead, we're getting a bull breakout 33. 33 closed at a new high. That's good for the bulls. Could it be a vacuum test of the measured move of the triangle here? It could be, but do you really want to sell when you're expecting a second leg up, leg one, pull back, leg two? If it is a leg one, leg two, to give you an idea, and I don't know, you can use bodies, you can use extremes. I'll use extremes for this one. Your leg two measure move is all the way up here. And so if this was strong enough for a symmetrical second leg, we just got a high two, and we're getting the bull breakout. Like I said, there wasn't enough selling pressure in here for any major reversal. And 33, bears aren't going to sell below 33. It's a 4-bar micro channel. It's a fairly strong bull bar. So we might be at resistance, but it's like I said, resistance is not holding. If this is a bull trend, we're going to continue straight through it. 34, another bull bar. If you're a bull and you see this measured move target, and you sold, but you're getting a bull bar. Closing looks like one tick above it. Closing one tick above the resistance. The market didn't do exactly what you expected, because if you expected the market would just go straight through your profit target, you wouldn't take profits there. Bulls were maybe expecting, bulls who had profit taking limit orders at this measured move were expecting a bar like bar 46 yesterday. We go up, we test the resistance, and we come back down. That's the point of taking profits there, because you don't think the market will go higher. But now you have a 5-bar micro channel, and leg 1, pullback, leg 2, but still strong enough. Probably the first reversal will fail, and this could be a bull trend. The bulls have now controlled more than 20 bars above the moving average, and the bears have had 5 weak bars and 20 bars. And then everybody bought on 35. We tested this resistance and then broke straight through it. If you're an aggressive bear selling this resistance, what happened on bar 35? If you didn't exit on the momentum up, you probably exit above the bar, because this is not a scenario where you scale in. Scaling in does not fix a bad trade. And you have to recognize when your premise is invalid and when you're incorrect. Because think about it, if you're selling there, I erased the line, but you know it's about the close of 34. If you're a bear selling the close of 34 with a limit order, you might be willing to scale in a little, but when this happens, you know you're incorrect, and you have to buy back your shorts. And that's why there's follow through 36, and you can see where we went straight through. Here's a measured move of the breakout using the bodies, and we're going straight through it. Is 35 and 36 climactic? Yes, it is. You got to think about what kind of breakout it is. We know it's not a breakout gap because the trend started down here, and this might have been the breakout gap. So this is either an exhaustion gap and a leg 2 trap, or a measuring gap. And the reason why I don't think it's an exhaustion gap, for a couple of reasons. You look to the left, and there's a lot of space to the left. The market's not in a trading range. The market's in a trend. The market's trending. We're getting higher highs, higher lows, not much selling pressure. And the sell-off, or the pullback, was fairly shallow. And now you're getting consecutive big bull bars closing near their highs, and we're all above the moving average. It's more likely this is a measuring gap. And what's a measuring gap? So you take it from the start of the bull breakout to here. And so this might be a target for the bulls. The market's clearly racing higher, looking for some level or some magnet. For me personally, I see 35 and 36, and even though it's more likely a measuring gap, it's big bars and giving you a windfall of profits, and they're going to attract profit taking. And big trend bars in general will attract profit taking no matter the context. And because of that, the expectation after any sort of climax is 1 to 3 bars sideways. And then the market decides, are we continuing, going higher, or reversing down? And so, of course, in this context, we have a strong bull trend, a strong breakout, 35, 36, a little bit climactic, but is this going to be the high of the day? Probably not. This will probably get a second leg, and this was strong enough that it would reset the leg count for me. So I said this was leg 1, and so you can see it as this is leg 1, pullback, and then a second leg up. But again, this was strong enough. That's one of the ways I define a leg 1. You get a breakout that's strong enough to reset the market cycle. This is a breakout that I would consider strong enough that it's resetting the market cycle. It's leg 1, and it's probably going to get a second leg. 37, disappointing for the bulls, but think about the bears. Where has a bear made money in the past 30 bars? They're not making money on stops. If they sold above 26, they had a chance to make a scalp, and that's it. It's a lot easier. The point I'm getting at, it's a lot easier to make money buying. And so 37, you can say it's a disappointing bar for the bulls. But it's not so disappointing that they're going to sell below it and exit their longs. Just look at what happened. The odds are this is a minor reversal. It's bulls, similar to 23. The risk got so big that they're reducing their position size. And like I said, climaxes lead to 1 to 3 bars of sideways. Inside bar 38, high 1 buy setup, but consecutive trading range bars overlapping each other. It's more likely we'll get trend continuation, so a breakout to the upside, but there's probably sellers above 38 and buyers below because it's trading range bars. 39, 3 consecutive bars with equal lows, and so on some lower time frame, I forget if you can call it a ledge. I thought a ledge was 4 consecutive bars with the same high or the same low. This is either a ledge bottom or it's a wedge. And so on a smaller time frame, it's a wedge bull flag. We had a bull breakout, pullback leg 1, leg 2, leg 3, and then a bull bar closing above its midpoint. Probably buyers above 39. And what's your argument for the bears here? If you're a bear, there's no major trend reversal. If this was a leg 2 trap, leg 2 traps typically work quicker than this. You have a buy climax high in a trading range, which we're not, that we can clearly see. Well, let me back up with that because I want to be clear. Breakouts are always vacuum tests of support and resistance. The problem is you're not always at the resistance that it's looking for during the breakout. Like here, this is a strong breakout. Bears are arguing this is just a buy vacuum test of resistance. But the market's going higher. It's looking for resistance even higher. And the same applies here. Big breakout and kind of climactic, but it's so strong and the context is good for the bulls. What do the bears have to argue here? There's no major trend reversal setup. It would take a really low probability event for this to turn into a bear trend. The worst case is we get a deep pullback. Even if it is an exhaustion gap, maybe we close this gap with the bar 23 high, and then the market goes sideways in the trading range. That's the worst case scenario. Maybe 20% chance that this sells off into a bear trend. And now 39, remember I said this was strong enough to reset the leg count. So if this is leg 1, it's early in the market cycle. Now we're getting a high 1 early in the market cycle with a good signal bar. Probably buyers above. Bears exiting shorts if they were aggressively trying to sell, and bulls looking to get long. And then 40, a bull breakout bar. It's a good looking bar. And you're getting to a point where more and more computers might see 3 pushes up. It's not very symmetrical. The distance between the first and second push is a lot bigger than the distance between the second and third, but it is 3 pushes up and it's consecutive buy climaxes. So if nothing else, you'll have bulls who have been buying all day, maybe looking to take profits. But as far as selling to initiate a short, I would not. And this bar reached the measuring gap, measured move, and there are always other measured moves. Maybe a measured move of 35 and 36. That would be the next one I look for. This type of day is the always-in trader's dream. Always-in can be a tough subject or a tough concept to actually apply to trading because the market, most days are trading range days, and the market's in a trading range most of the time. And so always-in is ideal for trending markets. And at this point, you have to be able to assess the chart and say, okay, this is a bull trend. This is not a trading range. And so because of that, the always-in style of trading and swing trading will actually do really well. And what you do is you buy anywhere, you know the market's in a bull trend, and you just keep trailing your stop below major higher lows. So if you bought anywhere down here, you get this pullback, breakout to a new high, stop goes below 12. New breakout, pullback, new breakout, stop goes below these lows. New breakout, maybe your stop goes below 35 or 36. New breakout probably goes below 39. But with bar 40, I said maybe 3 legs up and maybe profit taking, but any reversal here is minor. 41, it's a bear bar, it's a reversal bar, it's a strong looking bar, but it's less than half the size. 5.5 points versus 3.75 point bar. It's a smaller bar than 40, and the first reversal down will probably fail. This is actually still a micro channel since down here. And so how many bars is that? 1, 2, 3. It's a 12 bar micro channel. It's very extreme behavior. And remember I said after 7 bars, the odds actually favor a pullback. We're getting to the very extreme level of 12 bars. And so a pullback is likely, but that doesn't mean a major trend reversal is likely. So it's probably buyers below bar 41 and then scaling in lower. 42 consecutive bear bars, but again, look at the context. Bulls will actually look at these bars as a discount. You have bears who sold above 39, betting it's a high one late in a trend. They got trapped. So if a bear did sell above 39 or any of these bars, the market's retesting that price. So you'll have a bounce there because of those bears who got trapped into a bad sell. And you have bulls who didn't buy, looking to buy because the market's continuing higher. And then you got a bull bar 43. The past 4 bars are overlapping each other, so the market's in a tight trading range here. But it's minor. It's really a bull flag and a pullback in a bull trend. This is still not a major reversal. Bears desperately hoping this is a wedge, 1, 2, 3. But bull trends are always creating wedge tops, and there's just not enough selling pressure. All the bars are above the moving average. You've had 2 decent but small bear bars in almost the entire day. Bar 4 was the other good bear bar. These bars have tails below. Bar 2 is small. These bars have tails below, tail below. So the selling pressure today is just almost non-existent. So second reversal below 44, but probably buyers below. It's a minor reversal. And that's why 45 went almost outside up. Technically, with Al's definition, as long as the highs are the same price, which they are, he would call 45 an outside bar. For the strict definition, obviously, an outside bar, the low has to be below the low of the prior bar and the high above the high of the prior bar. But as long as it breaks out to one side and then has the high at the same price as the prior bar, then it functions the exact same way. So 45 is an outside bull bar, trapping the bears, looking for a second reversal down. So it's similar to down here. Bull trend, first reversal, failed, second reversal, failed. The bears gave up. Up here, bull trend, first reversal down, they failed, second reversal, they failed, reversing up. Bears will give up above 45. It's another high 2 above 45. Bulls will buy. And then that's why 46 raced up. And where are we racing to? There's the measured move, 35, 36. Getting close to that. We'll probably get there. 46, a good bull bar. But again, might be 1, 2, 3. Bulls see 46, windfall of profits, 3 pushes up. It's a good place for profit taking, but it's not a good place to initiate a short. And so that's why the bear bar 47 is profit taking by the bulls. It's probably not bears taking an aggressive sell. This is a relentless bull trend. Remember I said it's a low probability day, what happened today. And that's why it's challenging. You see these breakouts that could be exhaustion gaps, and they should have, or you expect them to reverse and close the gaps, but they just continue higher and higher. You think about the selling pressure today. It's like I said, how many good bear bars are there today besides 4? And what was the context of 4? Remember that. Bear bar 47, minor reversal, strong enough here, probably going to get a second leg. It could be 3 legs up. It could also even be 1 leg. The breakout's so strong and went far enough above the bars to the left, and it's a bull trend. Leg count's always resetting in a bull trend. Leg counting, that's another important point. Leg counting is really useful in trading ranges. When you're in a trading range, you have to count legs. Maybe 1, 2, 3 legs up, look to sell. 1, 2, 3, maybe 3 or 4 legs down, look to buy. 1, 2, look to sell. In a trading range, that's why it's so important. But in a trend, the way you count legs in a trend is you count legs for the pullbacks. So what do I mean by that? I'm not counting leg 1, leg 2, leg 3, look to sell. What I'm counting is we have a strong breakout, leg 1, pullback, leg 2, look to buy. Up here, 1, 2, 3, look to buy. Up here, 1, pullback 2, look to buy. That's the way leg counting is used in trends. 48, going more sideways, might be sellers above, but this is a minor reversal. Any pullback, any reversal attempt is minor. Buyers below, and then more breaking out to the upside. I didn't even show this yet, and I think it's important. And that is the amount of gaps that are open today. You can say the high of yesterday, you can say this breakout point. But where did the bears who sold here get a chance to exit? That's a lot of open space. They got trapped, and that's what led to the second leg. And then what happened here? Maybe a bear sold above 39. Maybe, if they were lucky, they got out at break even, but that's still an open gap. Here, the same thing. Bear sell above 41. Trapped on the breakout 46. And then where do they get a chance to exit? They don't. And that's another open gap. And then I didn't even show this one. Breakout point here, absolutely no overlap. So these are big open gaps. And gaps represent trapped traders, and trapped traders provide fuel. And so bears are just getting squeezed worse and worse out of their trades, forced to liquidate. So another breakout 49. Is it 3 legs up and a wedge top? No. It's a strong bull trend, and they're always creating wedge tops and bull trends, but they're minor reversals. So there might be profit taking on 49, but it's not a major trend reversal. Follow through, 50. Bull breakout and follow through, probably going higher, open gaps. 51, profit taking by the bulls. But 51 is similar to 41. You have a tight bull channel, a bear reversal bar. It's a good looking bar, but there's probably more buyers below. Now, it's not the ideal signal bar for limit order bulls to buy below. Maybe they wait to buy the breakout point or the 50% of this breakout. But the point is, there's buyers below, and this is a minor reversal. Inside bar 52 lowers the probability. Buyers below, maybe sellers above for a scalp, but really bad in this context. And then breakout 53 to a new high, consecutive bull bars, probably going higher, tight bull channel. Your options are to be long or flat. Always in, still relevant. If you're trading always in, there's no major trend reversal set up. Where's your reason to exit longs? Of course, at some point you want to take profits, but if you can leave a runner and swing a part of your position, there's been no reason since, I don't even know, this is a pretty decent breakout for a second leg, no reason to exit here. There's been no reason to exit longs if you're using the always in approach. And you can always exit below a bear bar, closing below its midpoint like here, 41, but then you just buy again above a bull bar, 45. I would say 43, but it didn't trigger. 54, we have an inside doji. Might be profit taking above, sellers above, but also buyers below. It's a minor reversal. 55, climbing higher. And again, you might have some traders seeing this as 3 pushes up. But it's a strong bull trend, so if it is 3 pushes up, it's a place for taking profits. It's not a major trend reversal. And then more to the upside, 56. Might be by the close. Really hard psychologically when the market's just been going up and up and up. And again, that's why I mentioned in the beginning of the video, you can't beat yourself up on days like this, and it's really challenging. And I know for me especially still, it's challenging when the market's doing something like this. It's just a low probability day. You don't see this often. You see this once a month maybe. These relentless trends. And again, beginners look at this day, they think trading is so easy. You just buy somewhere down here and hold. But everyone knows it's not that easy. Consecutive bull bars, micro channel, probably buyers below. 57, a big outside bar for the bears. Now, the problem with 57, there's a couple problems. 57, it's an outside bar. And remember, outside bars, trading range bars. The context, tight bull channel, strong bull trend. So you have an outside bar. So if you're selling 57, you're selling low in a trading range within a strong, tight bull channel. And that's a problem. But 57 was a big enough surprise. There will be some sort of reaction, some sort of second leg. But you will have traders buying below, buying the close of 57, betting that's a minor reversal. And what's interesting about 57, as big and as strong a bar it is, it's probably profit taking by the bulls, and it wasn't even a significant trendline break. If the bears got another bar, 57 on 58 down to here, that would be more significant. But for now, really not that much damage for the bulls. It is damage, like it is a bull. It is a big bear trend bar. And so bulls who bought 56 are going to be disappointed by this. But a bull who bought the close of 56 and scales them lower is probably going to make money. Bears, selling 57, selling down here, it's like the worst place you can sell because of the context. 58, another bull bar, disappointing for the bears. So bears, if they front run the breakout, they sell 57 close or below. 58 disappointed them, and then we're probably going to test at least, well, we already did test the low of 56. That was expected. That becomes resistance. And then we're probably going to test the close of 56 as well. Do bears want to sell above 58? I don't know. There might be. They should get a second leg, but the second leg could be really minor because the context is not good to be looking to sell. And then 59. The low of 59 could be that second leg. Breakout 57, pull back to the high 58, down to the low of 59. There's your second leg, and then a reversal. Probably buyers above 59, going higher. 60, going higher, but channeling up after this breakout. Now we have 3 consecutive bars that have a good amount of overlap. We might be getting late in the bull trend. We also haven't touched the moving average in well over 20 bars. So that sets up a 20 gap bar buy setup. The first time the market touches the moving average in a scenario like this, you think about it, the bulls have been buying above the moving average all day. So if they get the chance to buy at the moving average, the average price, one measure of average, they're going to take it. 61, inside bar, maybe high in this range. Maybe the market starts to go more sideways here. So not an ideal place to be buying. 62, it's a high one within a bear bar, and so all these bars are overlapping, and it's a trading range. And it's a trading range within a bull trend, so bulls will argue it's a bull flag. Bears, they want to argue big enough surprise. We might get a double top, but this is not a major reversal yet. Not a major trend reversal setup. 62, high one, sellers above. Outside down, 63, but now probably going to find support in the middle or lower part of this trading range. And then buyers below on 64, double bottom, might have buyers above, but the upside might be limited. We're getting fairly late in the day. It's a bull trend day, and bull trend days often have profit-taking sell-offs late in the day. You have bulls who've been buying all day. At some point, they got to take profits. And then 57, big enough surprise, it might have started a trading range. If we get above 57, which I think we will, if we do get above 57, there's probably sellers above there. Inside bar, 64, but 2 legs down within a bull channel, a tight bull channel, possible double bottom, buyers below. 66, now we have a signal bar for stop orders, buying above 66, bears probably exit above 66. No trigger, but now it's 1, 2, 3 pushes down. And a wedge, double bottom. It's a double bottom, bull flag, where the second leg was a wedge. Buyers below 67. Inside bar, 68, II pattern. Breakout mode, but the context is bullish. Now we have a triangle and II, possible final flag. Maybe we go above 57, and then we remain in a trading range, and maybe we get that end of day sell-off from the bulls, and maybe the bears can capitalize on it. Stop order triggers, 69, good entry bar. Consecutive bull bars, they're not climactic. but they have big bodies and small tails, closing on their highs, probably going higher. 70, still going higher, but there is resistance to the left, the 57 high. There will be sellers above. Inside bar 71, high one, but late and now in a trading range. 72, another doji, probably sellers above, testing resistance. If you're a bull, probably look to exit here because we're late in the day. We have not had that end of day profit taking sell off yet, and we may have seen the high of the day, or we may get a little higher, but I suspect the upside is limited. 73, a bear bar, sellers above, and in a trading range, so I'll just draw another horizontal line. The market's between these two horizontal lines. When it's up here, they're selling. Down here, they're buying. We get low, they buy. We get high, they sell. Now we have a bad high one, 3 consecutive non-bull bars, probably sellers above. Now we have consecutive bear bars, probably sellers above 74. 4 bars without a bull bar. And since 57, big enough surprise. We expected a second leg down. We got a second leg down, but now the past 20 bars have been sideways and in a trading range. So we're high in a trading range. We had 2 legs up and probably more sellers here. And now we might be getting a little bit of an endless pullback. Outside down 75. If you're long, you might be starting to think maybe we've seen the high of the day. Maybe you just exit below a bear bar. And then a give up bar, 76. And so this is the end of day sell-off I was talking about. Double top, 57 and 72. I thought we'd get a new high of the day. We ended up not getting one. The 57 high, regardless, was resistance. 2 legs up in a trading range for the bulls. This is probably a leg 1 for the bears. This was a pullback for the bulls. So you could also view it as leg 1, pullback, leg 2. But this was so long ago. This also was a pullback for the bulls. I hope it's not confusing what I'm saying. Strong bull trend, pullback 57, and the bulls tried to get continuation, pullback, second leg up, 1, pullback 2. The market's in breakout mode. The bears trying to get below this red line, the trading range low, and then they broke out 77. 77 could have been stronger. It's a trading range bar, but it did close below a lot of bars to the left. The bears want continuation, and it's tight enough that there's probably more sellers above. And then 78, we went a little lower, but it's minimum follow through. It's actually a buy reversal bar, so it's a doji, but closed above its midpoint. Sellers above, and probably more sideways into the close. And 79, instead of going above, we sold off on the close of 78. And this is, again, that profit-taking sell-off at the end of a trend day. And then just sideways into the close. For always in today, we started in a trading range. So it was buy low, sell high in the beginning of the day in here. But I thought it might have been always in long 9 or 10, or 8, 9 or 10, but high in a range, not necessarily clear. But I thought it became clear on bar 19 that we were always in long, and it's pretty straightforward always in long explanation today. We never flipped until probably here. The market's in a trading range, and you have 2 legs up, probably always in short, because always in becomes opposite in trading ranges. So all through here, there's no reason for always in traders, or what I mean by always in traders is if you're holding a long position and you're trading always in, you're looking to exit below a major trend reversal setup. And one just did not come today until maybe here. And even this was fairly weak. But because of what I said, there's additional context with the certain expectation of a sell-off into the close. But all through here, bulls can exit below a bear bar, but it's always in long. They got to buy again above 27 or 30. Maybe you exit here, buy again 45. You don't get out below 51, it doesn't trigger. 57, I understand wanting to sell out of longs below 57, but it's actually a bad place too. And it's actually better to look to buy there. But then through here, maybe you exit below, maybe 63, but you can buy again above 68. It's still always in long, but obviously becoming more of a trading range. Then in here, it's more clear. We're really finding a loss of momentum high in the range. And then 3, 4 consecutive bear bars might be always in short, and that's why 76 was the give up bar. Stop order trades today. I thought there were probably buyers above bar 5, double bottom. And then you can consider it stop orders or buy the close here. Buy the close or buy above 19, 20, 21, 22. Buy above bar. You could buy above 27 or 26, high 1, wide stop. Probably higher probability to wait for the second reversal after 3 consecutive bars down. So buyers above 30. And then through here, buyers above. It's a bull trend, and you can buy above any bull bar. And then here, buy the close. High 1, 39, but on a lower time frame, it's a micro wedge. Bull flag, buy above 39, buy above 45. Also, goes back to always in. If you exit for any reason, just buy again above a bull bar, closing above its midpoint. So any bull bar up through here, closing above its midpoint, you can buy above. And then, obviously, a little climactic. Maybe 1, 2, 3 pushes up, and obviously the 57 surprise bar. But as far as stop orders there, really it flipped the market into maybe a trading range. So limit order market, buyers below, sellers above. I thought 68 was a reasonable stop order trade, but where do you exit? Maybe the 57 open, maybe a new high. You start to get stalling here, bad high 1, sellers above. That's a limit order. I'll get to that. 75, consecutive bear bars, possible endless pullback, high in a range with the added sell-off probability. Might be sellers below 75, give up bar, sell the close, 76. And that's it for stop orders. For limit order trades today, I thought sellers above 1, sellers above 2, sellers above 3, buyers below 1, micro channel buyers below, so they came in here and here. Bad, I mentioned this one earlier, it's a bad sell setup, 14, probably a minor reversal, buyers below. Same with 16, buyers below. Micro channel, buyers below. I really liked the trade 29. When you think about the logic of it, strong breakout, 2 legs down, inside bar. The odds are the breakout to the downside will fail and we'll get a high 2. And a lot of traders see this. I know I saw this as the high 2, where 30 is the high 2 signal bar, you buy above 30. But one thing I learned is that you remember that price action is fractal. And so the high 2 actually occurred on some smaller, infinitely smaller time frame at the low tick of bar 30. At some point, the market finally came to the low of 30 and then reversed up, and that was a reversal point. And so it's an advanced entry, but a good limit order trade is to buy below bar 29 in a strong bull trend, 2 legs down, weak 2 legs down, inside bar, expecting that high 2. Strong breakouts, buyers below bars. It was so strong that actually, again, this was like a 12 or 13 bar micro channel. 41, buyers below, minor reversal. Same with 44. All the way up, buyers below 56, trapped on 57. You can see they exited on 58. That's why we pulled back. And then bad high 1 here, sellers above, high in the range, bear bar. And these, it was a 4-bar micro channel, but you can see it as a wedge, you can see it as a channel on a smaller time frame. The tail is an overlap. 3 pushes down, buyers below these bars, second leg down here, low in the range, buyers below 65, and buyers below here. I'm not sure if it triggered. It actually did, so buyers below 67. And then up here, bad high 1, sellers above 71. And then another bad high 1, maybe a high 2, above 74, sellers above, and then sellers above these bars into the close. Where do we go tomorrow? It's common after strong trend days, so in this case a strong bull trend day, that we'll get sideways to down within the first 2 hours of the next day. We already started going sideways into the close of this day. I suspect we'll continue to go sideways with buyers below and sellers above, but this was a relentless bull trend, and there might be an added chance we go higher tomorrow. As always, please feel free to leave questions in the comments and include timestamps for any questions specific to this video. And with that, I hope everybody has a good rest of their night. Thanks for watching.